Imagine two people standing at the same financial crossroads. One sees uncertainty and waits, the other sees uncertainty and starts preparing. 20 years later, their financial lives can look completely different. That's what happened after the financial crisis of 2008 and 2009. When the stock market collapsed, fear was everywhere. Companies were failing, unemployment was rising, retirement accounts were shrinking, and millions of investors were wondering whether the financial system would ever recover. But some people kept buying assets while everyone else was trying to escape them. They didn't know exactly when the market would recover. They didn't know which company would become the next giant. They simply understood one important principle. When quality assets become cheaper, long-term investors get an opportunity. And that principle matters today for a completely different reason. We are entering one of the largest transfers of wealth in modern history. Over the coming decades, estimates suggest that roughly $124 trillion in assets could move from older generations to younger generations and charitable organizations. That's an almost unimaginable amount of money. But here's the part that matters most. You don't have to inherit millions of dollars to benefit from what's happening. In fact, most people won't. The real opportunity comes from understanding what happens when enormous amounts of capital move through an economy. Money doesn't simply disappear from one generation and appear in another. It gets invested, it gets spent, it buys homes, it funds businesses, it moves through financial markets, it creates jobs, it changes industries. And if you understand that process early, you can position yourself before the biggest effects become obvious. So today, let's break down what this wealth transfer means, why it matters, and what an ordinary investor can actually do about it. Because the goal isn't to predict the future, the goal is to be prepared for it. The lesson from 2009. Let's go back to March 2009. The S&P 500 had fallen dramatically from its previous high. Investors were terrified. The financial system had just experienced one of its most severe crises in generations. Imagine putting money into the stock market at that moment. It wouldn't have felt intelligent. It would have felt reckless. Your friends might have told you to wait. Your family might have told you that the market could fall even further. The news would have given you plenty of reasons to stay away. But eventually the market recovered. And then it kept going. Over the years that followed, stocks experienced one of the strongest extended periods of growth in modern history. People who continued investing through their retirement accounts participated in that recovery. And many of them became significantly wealthier without ever becoming professional investors. They were teachers, engineers, nurses, business owners, office workers, people who simply kept contributing to diversified investments year after year. That's an important lesson. Massive wealth isn't always created by discovering the next incredible stock. Sometimes it's created by owning productive assets for a very long time. People who simply kept contributing to diversified investments year after year. That's an important lesson. Massive wealth isn't always created by discovering the next incredible stock. Sometimes it's created by owning productive assets for a very long time. The $124 trillion question: baby boomers accumulated an enormous amount of American wealth during their lifetimes. They benefited from decades of economic growth, rising property values, expanding financial markets, business ownership, and retirement investing. Now that generation is aging, and eventually those assets have to move. Some will go to children, some will go to grandchildren, some will be donated, some will be sold, some will be reinvested, and some will be used to purchase homes, businesses, services, and other assets. Research from Cerulli Associates has estimated that approximately $124 trillion could be transferred through 2048. That's not money appearing from nowhere. It's accumulated wealth changing hands. And this distinction is extremely important. You shouldn't build your financial plan around the assumption that you'll receive a large inheritance. You might not. Your parents might not have significant assets. Or there may be several family members sharing the same inheritance. Taxes, healthcare expenses, debt, and other costs can also reduce what eventually reaches heirs. So don't wait for an inheritance. Build your own financial foundation. The wealth transfer should be viewed as an economic force, not a personal financial guarantee. Where does all that money go? This is where things get interesting. Imagine someone inherits $500,000. They don't put the money under their mattress. They might invest part of it. They might purchase a house. They might start a business. They might renovate an existing property. They might pay off debt and increase their disposable income. Every one of those decisions sends money somewhere else. The home purchase benefits a seller. The renovation benefits contractors. The investment purchases financial assets. The business investment can create jobs. The spending creates revenue for companies. That's how wealth moves through an economy. And when the amount of capital involved reaches tens of trillions of dollars, the consequences can become enormous. This is why the wealth transfer isn't only an inheritance story, it's an economic story. You don't need to predict the winning sector. One temptation is to hear about all this money moving around and immediately ask, which stock should I buy? That's usually the wrong first question. Nobody knows with certainty which company will dominate the next 20 years. Nobody knows which technology will completely transform an industry. Nobody knows exactly where interest rates will be. And nobody can consistently predict every market cycle. Instead of trying to guess the single winner, you can own a diversified collection of productive assets. For many investors, that means broad market index funds. Why? Because when the economy grows, you're participating in that growth across hundreds or thousands of companies. You don't need to know which individual business becomes the next superstar. You own the market, and that's one of the most powerful ideas in long-term investing. You don't have to predict everything, you just have to participate. The generational shift in investing. There's another interesting part of this wealth transfer. Younger investors don't necessarily invest the same way their parents did. Older generations traditionally relied heavily on stocks, bonds, real estate, pensions, and traditional savings. Younger investors are increasingly interested in technology, alternative investments, private companies, digital assets, sustainable businesses, and other emerging areas. That doesn't mean every new investment trend will succeed. Many won't. Some will disappear completely. But the underlying shift matters. As trillions of dollars move to younger generations, investment preferences can change. Capital may move toward industries that previous generations didn't emphasize. Artificial intelligence is one example. Clean energy is another. Healthcare technology is another. Digital infrastructure is another. But here's the important warning. Don't confuse a growing industry with a guaranteed investment. An incredible industry can still contain overpriced companies. The smarter approach is to understand the trend while maintaining diversification. Real estate could change too. Housing is another area where generational wealth transfer could have a major impact. Think about the millions of properties currently owned by older Americans. Over time, some of these homes will be inherited, some will be sold, some will be rented, others will remain in families. That could create very different effects in different parts of the country. A retirement community losing population could experience increasing housing supply. A growing city attracting younger workers could experience increasing demand. That means location becomes extremely important. Real estate isn't one national market, it's thousands of local markets behaving differently. Population growth matters, employment matters, infrastructure matters, taxes matter, housing supply matters. If you're considering real estate as an investment, don't simply ask, are home prices going up? Ask, where are people moving? Where are businesses investing? Where are jobs being created? Where is housing supply limited? Those questions can tell you much more about the future than national headlines. The most important strategy is still boring. Here's where the entire discussion comes back to something surprisingly simple. Consistency. Imagine someone who invests $500 every month, not once, not when the market looks attractive, every month. During bull markets, during recessions, during political uncertainty, during scary headlines, during market crashes. They keep buying diversified assets. That person doesn't need to know when the next market bottom will happen. They don't need to predict the next recession. They don't need to understand every economic report. They're using time as their advantage. At a hypothetical 7% annual return, investing $500 every month for 25 years could grow to roughly $405,000. Increase that contribution to $1,000 per month, and the same hypothetical return produces roughly $810,000. And that's before considering employer contributions, income increases, or longer investment periods. The exact return won't be 7% every year. Some years will be negative, some years will be spectacular. That's not the point. The point is that regular contributions combined with long periods of compounding can create surprisingly large results. Don't wait for the perfect moment. This is where many investors make their biggest mistake. They wait. They say, I'll invest after the next crash. I'll start when interest rates fall. I'll invest when the economy improves. I'll wait until the election is over. I'll wait until stocks become cheaper. There's always a reason to wait, and sometimes waiting feels intelligent because you're avoiding uncertainty. But the problem is that markets don't send invitations. By the time everyone agrees that conditions are safe, prices may already reflect that optimism. The bottom of the 2009 market looks obvious today. It wasn't obvious then. People didn't know it was the bottom. That's why long-term investing isn't about finding perfect entry points. It's about having a strategy that works without requiring perfect predictions. The wealth transfer could create opportunities beyond investing. There's another opportunity that people often overlook. You don't necessarily need to own the wealth. You can build a career serving the people who do. Think about what happens when trillions of dollars change hands. Families need lawyers. They need accountants. They need financial planners. They need estate specialists. They need real estate professionals. They need insurance experts. They need tax professionals. They need people who understand investments. They need businesses capable of helping families manage, protect, and deploy their assets. That creates demand. So if you're young and trying to decide which skills to develop, don't only ask, what job pays the most today? Ask, what problems will people have to solve over the next 20 years? Managing wealth is going to be one of those problems. Understanding technology will be another. Healthcare will be another. Real estate will be another. Data and financial analysis will be another. Skills connected to major economic trends can become extremely valuable. The spousal wealth transfer. There's another stage that happens before many assets reach the next generation. Assets often move from one spouse to another first. That means a large amount of wealth will increasingly be controlled by surviving spouses, particularly women who may have previously relied on their partners to manage investments and financial decisions. This creates another major need. Financial education, estate planning, investment management, tax planning, and financial independence. Families shouldn't wait until someone passes away before discussing money. If your parents are aging, understanding their financial structure can prevent enormous problems later. What accounts exist? Who owns them? Who are the beneficiaries? Are there wills? Are there trusts? What properties exist? What debts exist? What insurance policies exist? These conversations aren't exciting, but they can save families from years of confusion. What should you actually do? So let's make this practical. If you're watching this and thinking, okay, but what am I supposed to do? Start with the basics. First, build an emergency fund. You don't want to be forced to sell investments every time an unexpected bill appears. Second, eliminate expensive high-interest debt. Compounding works against you when you're paying extremely high interest. Third, take advantage of employer retirement programs where available, especially if there is an employer match. That's essentially part of your compensation. Don't leave it behind. Fourth, consider tax-advantaged accounts that apply to your situation. Retirement accounts can make a huge difference over decades. Fifth, invest consistently in diversified assets. You don't need 20 different strategies. A simple strategy you can follow for decades is often better than a complicated strategy you abandon after 6 months. Sixth, increase your contributions when your income rises. This is one of the easiest ways to accelerate wealth. When you receive a raise, don't automatically increase your lifestyle by the same amount. Let part of the raise go toward investments. You'll still enjoy the higher income while quietly increasing your future wealth. Seventh, continue developing valuable skills. Your income is the fuel that powers your investing. If you can increase your earning ability, you can potentially increase the amount you invest. And finally, think in decades, not days, not weeks, not even months, decades. Don't build your plan around someone else's inheritance. There's a psychological trap here. When people hear $124 trillion wealth transfer, they can start imagining themselves receiving a piece of it. But your future shouldn't depend on that. Your parents' financial situation is outside your control. Your relatives' decisions are outside your control. Their estate planning is outside your control. What you can control is what you do with the money you earn today. If an inheritance eventually comes, treat it as an accelerator, not the foundation. That's a completely different mindset. You aren't sitting around waiting for someone else's wealth. You're building your own wealth while preparing to handle whatever opportunities eventually come your way. The real opportunity, the most important lesson from the 2009 recovery, wasn't that investors needed to predict the bottom, it was that they needed to remain invested. And the most important lesson from the coming wealth transfer isn't that you need to predict exactly where $124 trillion will go. It's that you need to be financially positioned when it moves, have assets, have skills, have cash reserves, have a long-term plan, keep investing, avoid unnecessary financial disasters, and give compounding enough time to work. Because wealth creation rarely looks exciting while it's happening, it looks like an automatic investment every payday. It looks like buying an index fund instead of chasing the hottest stock. It looks like increasing your retirement contribution by 1%. It looks like keeping an emergency fund. It looks like learning a valuable skill on a Saturday morning. It looks like refusing to panic when the market falls. None of those actions will make you feel rich tomorrow, but repeated for 20 years, they can completely change your financial life. Final thought. There will always be another crisis, another recession, another market crash, another scary headline, another reason to believe that this time everything is different. But economic history has repeatedly rewarded people who own productive assets and remain invested through difficult periods. The coming wealth transfer may become one of the largest movements of capital in modern history, but you don't need to capture all of it. You don't need to predict every winning industry. You don't need to become a billionaire. You simply need to make sure you're participating, because the biggest financial mistake isn't always investing in the wrong thing. Sometimes it's spending 20 years standing on the sidelines waiting for certainty. There is no perfect moment. There is only the moment when you decide to start building. So don't make your financial future dependent on luck, inheritance, or the next market prediction. Build your own assets, increase your earning power, invest consistently, stay diversified, think long-term. And when the next major wave of economic opportunity arrives, you'll already be standing in the water. You won't have to chase it. You'll already be positioned to ride it. And years from now, you may look back at the decisions you made today and realize that they weren't dramatic at all. They were simply consistent. And sometimes that's exactly how ordinary people become wealthy. If you found value in this video, make sure to subscribe and turn on notifications so you don't miss future videos on personal finance, wealth building, and financial freedom. And if this message resonated with you, share it with someone who might need to hear it. Thank you for watching. See you on the next video.